Take a look at the options positioning around April 2nd. There's not too much to talk about, so clearly traders not exactly bracing for that date.
Well, I think there's something to talk about in positioning.
We should.
That's why I called up my buddy Bob Sloan.
I'm talking specifically April 2nd.
I'm trying to get into this intro here.
I know.
Right? Tesla is down over 40% from its peak back in December, but it may be one of the rare winners coming out of President Trump's proposed auto tariffs. That's because all of the cars it sells in the U.S. are made in the U.S., and even most of the components it uses are made here. Joining us now is Bob Sloan, founder and managing partner at S3 Partners, and according to S3's research, short interest in Tesla has rebounded after trending downward most of last year. In fact, Bob, welcome to the show. Good morning. Thanks for joining us. I was shocked to see that there's only, I think, on the Bloomberg I see, only 2.5% short interest in this stock.
You know, Tesla is the metric of American culture for the last 5 years. It has encapsulated everything economic that expresses itself in our markets. First, it's a meme stock. Then it's a financial soap opera fighting with short sellers. Then it's a technology stock. After the election, it's the best proxy of consumer sentiment and a political poll at the same time. It takes off in November, and then as tariffs and economic policy introduce itself, it sells off. If you want to understand consumer sentiment and reaction to economic policy, look no further than Tesla.
But Bob, one thing that really strikes me about the short interest you're seeing in Tesla is just how quickly the short interest has turned around. It wasn't too long ago that some of the largest institutional investors, short sellers, hedge funds, were too afraid to short this stock in fear of being squeezed.
Well, it's not, short interest was very low, as Matt pointed out early on. So, who's selling the stock? It's actually your long holders. It's not necessarily short sellers putting pressure on the stock.
Yeah, it's interesting. I mean, we were talking to Carson Block a couple of weeks ago, and what did he say? Don't bet against Elon Musk. He always seems to find a rabbit to pull out of a hat. So maybe that attitude, it's working its way through the broader market as well. Bob, I do want to move on from Tesla, and I want to talk about small caps. It's a topic I keep returning to because this is a trade that just hasn't worked. I know that you're keeping an eye on the Russell 2000 ETF, ticker IWM. What are we seeing when it comes to that short interest story?
Yeah, so we're not an investment advisor. We're a data company. Let's just keep that in mind. But one of the things that we've done is invert technical analysis. Most of the time, technical analysis is done on the broader market. We've done it on short interest indicator. And what you find is that when short interest gets to its resistance level and hits it, that's generally bearish for the stock. And actually for IWM, it broke out of its resistance level, and then actually about 89 million shares, and then came back down. So near-term, probably bullish signal for IWM.
We were talking about a story Michael Ball wrote for Bloomberg, kind of calling the non-event that tariffs would turn out to be, at least for today, because of options positioning. When you look at short interest going into, say, COVID or going into Russia's invasion of Ukraine, what can you learn? What lessons can you pull out of that and apply now, short interest going into tariffs?
Sure. So exogenous events are a fact of life, right? I mean, you mentioned many of them: COVID, Ukraine invasion, now tariffs. And what short interest does, it actually helps you understand how the market will react to exogenous events. So COVID, what happened? You had airlines sell off, but you had consumer staples like Clorox, P&G being bought. Same thing with Ukraine. You had, food being sold off, energy being bought. So now what we see is those companies and/or sectors like XOY, XOK, where you have either a dependency on foreign revenue, or you have a lot of your manufacturing being made outside the United States performing poorly. So short interest is a factor. It is very much like momentum or interest rates or value in and of itself to apply to risk management in your portfolio.
Bob, what kind of signals are you seeing when it comes to the short interest in the major indexes when you look at ETFs tied to the S&P 500, for example?
Yeah. So SPY short interest is going through the roof. It's broken through its resistance levels so much that it's actually probably setting up a new support level. That's called polarity. We see that, and we think that's bearish for SPY.
I also want to go around the world here. We've been talking for a few months now about this outperformance that we're seeing when it comes to European equity markets relative to U.S. equity markets. A lot of concern maybe that U.S. exceptionalism is fading, but it's a little bit of a different story. I mean, looking at your notes, as I understand it, people are sort of betting against that rally that we're seeing in Europe, Bob.
Well, you know, uncertainty breeds a certain amount of hedging activity. And I think you're seeing that express itself in European markets for sure.
Hey, Bob, Jamie Dimon and Steve Ratner both have made the point that the people they know and speak to on Wall Street, even those who didn't vote for Donald Trump, are still very optimistic for this term. And I wonder, you're also exceptionally well connected on Wall Street and here in New York. What are you hearing from the business community about, you know, the current vibes, for a lack of a better term?
Sure. So, well, first of all, thanks for the compliment. The second thing is stress tests out, Basel endgame in the cooler, balance sheet expansion is here. So when you look at the regulatory environment, you know, that's the next step in economic policy. There's probably $1 trillion of balance sheet that's available. In the coming years, there's probably never been a better time for fund formation. And what we're seeing is a recharacterization, reformation of market-making capital happen right before our eyes. There will be more multi-strats. I know people think that's a tight space, but the balance sheet will be available. And I think a great time to be in the fund formation business.
Bob, we thank you so much for your time today. That is Bob Sloan of S3 Partners.